Welcome to Outside the Dollar. I'm Elena Reyes, and today's episode is one I've been thinking through carefully because the headlines around gold right now are loud, and loud doesn't always mean clear. $6,000 an ounce. Bank of America just put that number on gold as their 12-month target, and before we move past it, the number itself deserves a moment. Because Bank of America didn't arrive at $6,000 by drawing lines on a chart. They built the case on three specific pillars: policy uncertainty around Federal Reserve leadership, persistent fiscal deficits, and what they call structurally low investor allocations to gold. Walk through each one. Fed leadership uncertainty is not abstract right now. Questions about who runs the Federal Reserve and how that shapes rate decisions feed directly into how investors price the dollar's reliability. When that reliability is in question, gold tends to absorb the demand. Fiscal deficits aren't shrinking either. The U.S. continues to run spending levels that outpace revenue, and there's no credible near-term path to closing that gap. That matters for gold because persistent deficits pressure the currency over time, and gold has historically priced that pressure in. Then there's the third pillar, which is the one I find most interesting: structurally low investor allocations to gold. Most institutional portfolios hold very little of it, somewhere in the low single digits as a percentage, if that. If even a fraction of that institutional capital starts shifting toward gold, the demand math changes in a way that's hard to overstate. Gold has already been moving. This target isn't coming from nowhere. It's a major bank saying the conditions that got prices here are still in place, and the buyers who haven't shown up yet are the ones who could push it further. So the $6,000 figure is worth taking seriously, not as a finish line, but as a signal about where Bank of America thinks the structural pressure is pointing. And the next logical question is who else is already acting on that pressure. So here's where the institutional picture gets specific. Goldman Sachs reported that central banks bought 59 tons of gold in April alone. China accounted for roughly 24 tons of that total. Let that land for a second. 59 tons in a single month. Goldman forecasts that pace continuing at around 50 tons per month through 2026, then moderating to about 40 tons in 2027. And the Goldman analysis makes something clear. This is structural, not reactive. A record share of central banks are now signaling plans to increase their gold reserves over the next 12 months. These aren't one-time trades. Now, central banks operate at a scale and with a mandate that individual savers simply don't have. They're managing sovereign reserves, hedging geopolitical exposure, reducing dollar concentration. The parallel isn't perfect. But the question they're asking is worth translating. If you're a central bank sitting on a large pile of dollar-denominated assets, how comfortable are you with that concentration? And if you're an individual with most of your long-term savings in paper assets, the question has a similar shape. Let's stress test that assumption. Central banks aren't buying gold because they think it's going to hit some price target. They're buying it because they want reserves that don't depend on any single government's fiscal decisions. That's a different motivation than price speculation. And that matters for how individuals should think about this too. The question isn't just how high can gold go, it's what portion of my savings is exposed to the purchasing power of a single currency. Which brings up something worth examining more closely: what gold's price behavior might actually be telling us about the dollar itself. So let me slow down here for a second, because this is the piece that tends to get lost. When gold's price rises, the instinct is to ask, what changed about gold? But that's often the wrong question. Gold doesn't change. What changes is the purchasing power of the currency you're using to price it. Think about it this way. If you had an ounce of gold in 2000, it bought roughly $270 worth of goods. Today, that same ounce is priced above $3,000. The gold didn't become more useful or more rare overnight. The dollar just buys less than it used to. And the math behind that shift is pretty straightforward. The U.S. money supply has expanded significantly over the past 2 decades. Federal debt has crossed $39 trillion. When you increase the supply of a currency without a proportional increase in productive output, each unit of that currency represents a smaller claim on real goods and services. That's currency debasement, and it's not a fringe theory, it's accounting. Now, I want to be careful here because this framing can slide into fear pretty quickly, and that's not where the useful analysis lives. The dollar hasn't collapsed, it still functions, but its purchasing power has declined steadily, and gold's price history largely tracks that decline. So when you see gold at $3,000 or hear a target of $6,000, part of what you're looking at is a running tally of how much ground the dollar has given up over time, which brings us to who's been paying closest attention to that tally. So the $68 drop, does it change the thesis? Peter Schiff made the case on his podcast that it doesn't. He flagged a roughly $50 drop on Friday and another $18 at the time of recording, putting spot gold near $4,135. His argument, pullbacks in an ongoing monetary expansion are entry points, not exits. Let me stress test that for a second. Schiff's logic rests on the idea that the forces driving gold, money supply growth, federal borrowing, Fed balance sheet expansion, haven't gone away because the price moved down 2%. That's a reasonable structural argument. If the macro conditions are intact, a short-term price drop doesn't change the underlying case. But here's what I'd push back on. Lower prices are a reason to look more closely, not a reason to act quickly. Pullbacks can deepen. Nobody times markets perfectly, not Schiff, not Bank of America, not Goldman. The question isn't whether to buy the dip. The question is whether the structural reasons you'd own gold at all are still in place for your specific situation. Gold doesn't move in a straight line. That's not a warning, it's just physics. Any asset with genuine price discovery is going to have drawdowns. The risk of acting on a dip is the same as the risk of acting on a spike. You're reacting to price movement rather than your own allocation logic. What the Bank of America target and Goldman's buying data gave us was a structural framework. A $68 drop doesn't break that framework, but it does create a useful pause, a moment to ask whether your reasoning is solid before anything else. And once you've decided the reasoning holds, the next question most people run into isn't about price at all. It's about who they're actually going to trust with the transaction. So once you've worked through the structural case and decided gold belongs in your portfolio, the next question is practical. Who do you actually trust with that transaction? Lear Capital put that question directly to their customers, and the results are worth sitting with. In a recent survey, Lear asked, when evaluating a precious metals company, what matters most to you? Company reputation came in first by a wide margin. 69% of respondents chose it. Think about what that tells you. Nearly 7 in 10 people said they're not leading with price, they're leading with trust. Transparent pricing came in second at 45%, competitive pricing third at 34%, years in business 28%, third-party ratings 27%. Now, I want to stress test that data for a second, because some people would say, of course reputation scores high on a survey. Everyone wants to say they care about trust. But look at the order. Transparent pricing outranked competitive pricing. People aren't just saying trust matters. They're telling you they'd rather know exactly what they're paying than find the cheapest number. That's actually a sophisticated consumer response. When you're buying physical gold or opening a precious metals IRA, the transaction isn't over at the purchase. Storage, buyback policies, fees over time, those costs compound. A lower headline price from a company you can't verify isn't a deal, it's a risk. So what does trust look like in practice? Not just a good feeling about a website. Verifiable ratings, third-party reviews, a track record measured in years, not months. And that's exactly the kind of evidence worth examining closely, which is what we're going to look at right now.
So what does that trust actually look like when you put numbers behind it? Lear Capital has been helping Americans buy physical gold, silver, and precious metals IRAs since 1997. That's nearly 3 decades of transactions, which means there's a real track record to examine, not just a marketing claim. Here's what the third-party data shows as of mid-June 2026. On Trustpilot, Lear holds an excellent rating across more than 3,100 reviews. The Better Business Bureau gives them an A+ with a 4.7 out of 5. Consumer Affairs rates them 4.8 out of 5 from over 1,600 reviews. And Google sits at 4.7 out of 5 across 637 reviews. And Retirement Living scores them at 5.9. Those aren't numbers from a single source that could be an outlier. That's consistency across 5 separate platforms, each with its own review methodology. The recognition from industry observers tells a similar story. Yahoo Finance named Lear a Best Value Gold IRA company. Consumer Affairs named them their 2026 Best Overall Gold IRA company. Retirement Living gave them a Great Service recognition. Now, I want to be direct about something. These ratings matter precisely because of what the survey data told us earlier. People said they lead with reputation, and they'd rather have transparent pricing than just the cheapest number. A company that's been operating since 1997 and still holds an A+ BBB rating has had to earn that through actual customer experiences year after year. That's the kind of verifiable track record worth checking before you hand over money for a physical asset you plan to hold for years. That's a wrap on today's episode. The key thing I keep coming back to, Bank of America's $6,000 gold target matters less than the 3 structural drivers underneath it: Fed leadership uncertainty, persistent fiscal deficits, and historically low investor allocations to gold. Those fundamentals don't disappear with a single price target revision. And Goldman's data on central bank buying in April, that's institutional behavior worth paying attention to, not as a buy signal, but as a question about your own portfolio concentration. Where is your long-term savings anchored? That's the homework this week. Want to keep exploring? Visit learcapital.com or text $, DOLLAR, to 43343 for your free investor kit. Leave a review if this helped you think differently. Thanks for being here.